Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
David Smith is a precious metals analyst and frequent contributor to the Morgan Report at silver-investor.com. He joins us from his home in Seattle, Washington. Hey, David, it's good to have you back.
Hi, Phil. How are you doing today?
I'm doing fine. It's a beautiful summer day. Great week. Gold moving sideways this week. Seems like the main contributors, David, a drop in the dollar and a rally in oil. And, of course, the Bernanke factor. What happened there?
Well, you know, the people are wondering if Bernanke is going to have another quantitative easing where they flood more money into the economy to kind of goose it a little bit, and because we're seeing some unemployment numbers and unemployment claims go up, and housing sales dropped quite a bit this last month, and people are looking at all those little different things. But you know, beyond all this, I think the metals people should be watching the fact to see how the world economy is going, and also things are going on in Syria where the government may be in the process of falling, and how that's realignment in the Middle East is going to cause things to go in relationship to Iran and the price of oil. So those things I think are really important. And then also the fact that the precious metal buying is very strong of the physical itself. So we're in the summer doldrums right now, and there has to be something really special happen in the summer to really goose prices one way or the other when you're in this situation, which could really continue right on into late August. You know, we can certainly see some good movement, but to expect a new major leg to rise up is probably not high probability right now.
Dave, you mentioned that new U.S. data. Here it is. Jobless claims up, factory activity down. I guess if things get worse in a hurry, do you think Bernanke will be forced to print more money even though he doesn't want to?
I really think so, and he can call it something else, but, you know, the people that look at the political scene say that, you know, he's going to have to do something fairly soon to have an effect for the election. Of course, the Fed is always supportive of the incumbent, and so they'll be doing it, and they're probably already doing it by working at going out the yield curve, or, you know, by changing the lending rate to banks and things. There's a lot of different things that they can do that are kind of beneath the radar, so to speak.
Okay.
And so you're going to see that, and how much effect that has is anybody's guess. But, you know, the Fed's not going to sit by and let things deteriorate without trying to do what they can, and it may not be very successful, but they'll be pushing hard.
Let's take a hypothetical scenario here that things do get worse. Bernanke does have to print more QE. What will that do to gold and gold prices?
It really depends on where that money goes, and it depends on the velocity of money. There are certain parts of the economy that have been, you know, perking up pretty good. I mean, our aerospace out here in Washington Space, Boeing is getting record numbers of plane orders, and that's helping the local area here. And then, of course, housing in different places in the country is starting to respond pretty favorably to demand, to new demand. And so, you know, it's going to be, if ever, when you get back to you can put a house on the market and throw a dart and sell it for twice what you paid for it. But a good quality house, there's demand out there, you know, and so there are pockets where the economy is improving. But as you know, we've got this huge drought going on in the Midwest with the corn and soybean and wheat crop, and that's going to push inflation into the basket, the food basket, and then that'll run downhill a little bit and go into the grains that are used for raising chickens and beef. And so we're going to see an inflation piece moving in there, and of course the Fed wouldn't be too unhappy about that. They'll flood some more money in and keep prices seemingly low, but with the inflationary effect, we'll start, debasing the currency. And metals traders and currency traders pick up on this stuff pretty quick.
Yeah. Now, we are seeing lots of talk in the financial press about deflation. Has anybody been factoring in inflation? It sounds like that's going to be a more realistic outlook for inflation.
Well, most people are concerned about, deflation now, and they don't think inflation has much chance at all. But really, there's a factor of how much money is in circulation, but it's really the velocity. Once the velocity starts moving up, in other words, how fast you and I turn the money that gets into our palms, that has the big effect on, the demand for goods and services. And so if velocity speeds up, either because the economy is getting stronger or because people are afraid that their money is going to be worth less, then that effect can be a multiplier effect. And those things, the Fed and other people and these economists, they think they can kind of really pin that down, but there's so much and it's so complicated and so many factors going on in these global, or not the global, but just the domestic economies, that it's really hard to come out and get it right, for even the near term, let alone looking out 6 months to a year or so.
We're talking to David Smith on This Week in Money. Let's talk about gold. Just below 1,600 as we're speaking, above the 20 and 50-day moving averages. Seems to be kind of range-bound. It's kind of caught in the summer doldrums here.
Yeah, I think it really is, and the thing is, all the eyes are on these charts and see, like you say, below the 50 and the 200-day, and the thing is, gold and certainly silver loves to do this. It loves to fake people out by dropping below, quote, support and then turning around after a few days. So whether that'll happen, there are some pretty astute analysts out there that think we're ready for another down leg, a significant down leg in gold and silver that could take, gold down a couple $100 more, maybe silver down $5 or $6, and that's possible. I kind of think that we've got a lot of support right where we are in here, give or take, a dollar where we are on either side, and we'll just see if anything is uncovered if they try to probe that lower level. But if a person wants to have a position, they should have something in here. They shouldn't be trying to be 100% out and then jump in when they think it's right, because they might be a hero and get it a few dollars less, but it also, if it takes off, they just might never get back on.
Dave, where is support for gold and where do you see resistance for gold?
Well, the obvious places on the chart are probably for gold resistance at probably, $16.50, $7 in $50 increments above where we are now, and then resistant support probably $50 below where we are now. And of course, another thing too has to do with how prices close on a given day. You could see a $100 drop in gold tomorrow, but if it closed up $5, that would be pretty impressive, because that would show that buying came in and took care of all that $100 drop and put it up slightly up on the day. And those things can happen. And then, boy, right after that, if you get follow through, that's when you start to see potentially a new intermediate leg. But I'm really looking at the mining shares, because they have been beaten down so horribly just across the board.
Yeah.
I mean, there are some of the finest companies out there that are producers I know one silver company overseas that has $200 million in the bank, and they're selling and record production, and they'll probably double their production over the next year, and they're selling at 1/3 of where they were a year and a half ago.
Wow,
I mean,
that's amazing.
It doesn't compute, but that's fine with me. I'm happy to pick up a few extra shares.
We're talking to David Smith here on This Week in Money. Let's talk about the gold-silver ratio for a second here. It's near 58. It's highest in 9 months. That's always an interesting signal.
That is, and there's a tendency for a lot of people believe that where we are now, that the ratio, if it unwinds, when it does unwind, it'll favor a bigger percentage of move than gold than silver, and of silver than gold, as it moves back to say maybe 40 to 1 or something like this. And that's kind of an arcane thing to look at, and I understand there's just some validity for watching when that gets out of what's seeming out of historical kilter. But for me, that's a little bit less exciting than trying to find a stock that I know is a good stock that's going to be around, and finding out that it's trading down where it was 3 years ago for no reason other than the fact of very poor sentiment across the sector and a summer doldrums where people just the volume dries up.
Sure.
And that's an indicator too. A lot of these stocks that are making new lows are making it on very low volume, which indicates to me that there's not huge selling going on. There's just the last of the weak hands are getting knocked out, and a lot of management is coming in and making buys in here too of these better run companies. So that tells you something too, I think.
Are we having a summer doldrums in silver as well?
Yeah, we really are, and it's just, there's so much going on, and people are kind of trying to game what's going on for coming up in the election. And I think as we move into the latter part of August and going into September, even before people come back from their European vacations, I think you're going to see more activity taking place in the mining shares and in physical gold and silver as people start trying to anticipate what's going to happen during the finale of the U.S. presidential electoral season.
Here's an interesting story, and I wonder if this would affect the price of silver at all. British salvage company reporting they've recovered 40 tons of silver from a cargo ship sunk in the Second World War off the coast of Ireland. $38 million bucks worth of silver.
I was reading about that the other day, and there'll probably be more finds like that. And in the scheme of things, it's not something that's going to tip the balance one way or the other. But I'll tell you what does cause supply demand, the projections to get out of kilter, is when you have a 700 million ounce deposit in Argentina, which the company says may not be developed because of the current restrictions and the writing of the laws there, that either may be years farther along or may not at all. That was going to be a 20 million ounce per year within a couple of years, new supply onto the market. And that silver is not going to get onto the market anytime soon, and maybe not at all. And that's just one of several type deposits of multi-100 million ounce deposits that have either been sidetracked because of legislation or the question of oppressive taxes, or even in one case, outright nationalization. Mm-hmm. So that's the type of thing that really starts putting a crimp in the supply-demand projections going forward.
David, you and I were talking about the situation down there in South America, not good for miners generally, and how we can benefit here in British Columbia.
I think British Columbia and Canada in general, but certainly British Columbia has a lot of potential, and the territories, especially Yukon, there's a lot of good land that has not been explored too well there in terms of silver and gold. The White Gold District up out of where the Klondike Gold Rush was around Dawson City, and then the Keno Hill area where silver is weighed by pounds per ton rather than grams per ton. I mean, that's amazing. And then there's a lot of small mills that were not any big shakes in BC that were closed due to low prices, not because they ran out of silver. So I think as more exploration is done with more modern methods and with a friendlier mining environment, I think you're going to see some very interesting production discoveries there. Whether we'll find one or more primary silver producers, I don't know, because as you know, most production worldwide is secondary. In other words, you get a lot of your ounces that come out of lead, zinc, and copper and that type of a thing, and silver is a secondary metal in relationship to how much comes out. But I'm sure we'll see more secondary discoveries over time in both of these areas.
David Smith is here with us today on This Week in Money. We were talking about gold and silver. Let's talk about the equity side for a sec. Here's a headline from foxbusiness.com. Gold ETFs lose shine, and they're asking if retail investors are losing confidence. Pulling $185 million out of the GLD this week, $95 million out of the IAU.
Well, some of these people are pulling that money out to put it in mining stocks, and some of them are putting it out to put in something else. But the thing you remember about a bull market is when prices are going up within the context of that market, you hear almost nothing but bullish news.
Sure.
And when you get a retracement, you hear almost nothing but negative news. So people are responding to what news is out there, what you just said. And in reality, if they believe the bull market is still alive, they should be buying selectively, whether it's an ETF or a specific mining stock, rather than selling into weakness. You want to sell into strength whenever you can, and that's given the huge retracements we see, where 50% reduction in price for a producer is not uncommon. We've seen some of the biggest ones on the board that have dropped 50% 4 or 5 times in the last 10 years, and those were opportunities to buy rather than sell. And of course, if you'd sold a little bit when it was overextended, then you'd have more dollars to buy on that 50% drop. But these things are common. Exploration companies they can drop 90%, And we have some companies out there this year out of Vancouver that have very good projects, highly prospective projects, and they may not have a drill season this year because they can't get the money, but yet they've got a great project. So it's been an uneven situation, and if you can sort out those stocks that are really beaten down terribly to what some people call idiot cheap prices, and buy a few thousand shares, my gosh, if they really get it right, you could be talking 10 to 20 times your money, but you got to be careful.
Dave, mining ETFs suffering as well. The GDX down 20% year to date. How are the biggest holdings of Barrick, Goldcorp, and Newmont doing so far this year?
I believe all are down on the year, except one. I think Barrick might be up 4% on the year. I was just looking at stats on that the other day, but they've all been they've all been hit really hard, and that's the thing. When you have a negative sentiment across the sector, almost nothing can rise. You could have a company come out. In fact, a couple of producers in the last few months that have announced record production, and they've lowered the cost per ounce by a couple dollars on their silver for production, and they'll drop to 5 or 10% that day. I mean, it doesn't make any sense, but that's just what it is. It doesn't have to make sense because sentiment is what it is, and when it's an extreme, just try to give people positive news. They don't want to hear it. But if that same company turned around and rose 350, over a week, people would be beating over the post to try to get in and buy some of that stock. But it's human nature. People don't want to buy lower prices, even when they're pretty sure that the company is a good one. But when it goes up and it goes right where they thought it would, now they're really interested.
Of course. Now, it's always difficult to find an entry point here in the markets being as volatile and crazy as they are. Well, what's your feeling on what we should do for the next couple of months?
I think a person should be buying tranches. They have a stock, let's say they don't have a position, and they go, this stock, I can't believe it. It's really a good price now, but it could go lower. So why don't I buy 1/3 right here at a limit price of where it is, because I think it represents a very good value. I've looked at the charts, and it's where it was 3 or 4 years ago. So I'll buy 1/3, and I'll put 2 more orders in, say 10% or 15% below each of those orders on a limit basis, good till canceled, and let's see what happens. And I put an article in for the Morgan Report worked last month on a particular company in Yukon, and I just put a scenario out there. I said, okay, it's right here it is now. Let's say that you have to have a position. So you buy right now and you put 2 more orders in. Well, that second, and I just put it out as a what for, not a prediction. That second order could have already been filled now, and the third one may well be filled too. So the person would have averaged down, and they would have bought each third at a lower price, which would have given them the position that they wanted, but at a price of about a 20% discount. And you can even refine that further by making, let's say your first purchase is 20% of what you want to buy, and your second purchase would be 30%. Okay, that'd be 50, right? And then if your third leg is hit, that's 50% of what you want to buy, and in which case you've got a nice average down price, and you're in a good shape. And plus, you're almost rooting for lower prices to get down to that lower level, which it may or may not do. But if it does, you've got a nice average price rather than going, oh, I need to have this stock. I'm going to put every cent I can in right now, and then watch it drop 20%, and then you panic and get out.
It's hard to avoid the casino mentality, right, when you're investing.
It is, but if you think about it, and you come out with this tranche idea, like I was suggesting, and you're doing it with a low emotional basis, it becomes more of a probability game, a statistical game, rather than just throwing the dice.
David Smith, our guest, he's a precious metals analyst and frequent contributor to the Morgan Report at silver-investor.com. Hey, Dave, thanks for your time. I appreciate it.
You bet. Good talking to you, Phil. Have a good day.
Coming up, Keith Schaefer on This Week in Money.
Always consult your investment professional before making any investment decision.
Keith Schaefer is our go-to guy for oil and gas here on This Week in Money. Keith, it's good to have you back here.
Phil, thanks for having me on.
Thanks for being with us. Oil down today, still headed for about a 4% gain this week. Obviously, a lot of things weighing on the oil price, the Eurozone, the Middle East, and the stronger dollar. Not surprising that things would pull back a little bit.
Yes, we've had a great run here after a miserable Q2 where oil just took such a beating. We're seeing a bounce back, I think, higher and stronger than most people would have thought, given the incredible supply glut that we're developing here in North America especially. But you're right, the Middle East has been the oil producer's best friend. You hate to profit at somebody else's expense, but certainly the Syrian situation has really got the world on edge a little bit, and that has really increased the risk premium in the price of oil again.
We got a couple of bullish signs for oil. Here's the news from the Energy Information Administration. They say oil demand in the U.S. is rising. Global oil demand up by $1 million barrels a day next year. That's a big jump.
Yeah, I think what we're seeing in the U.S. is that the gas, the oil products usage is improving. So it's still down a little bit over last year, but the reality is it's not down anywhere near as much. Earlier in the year it was down 4 or 5%. Now it's down 1%. The odd time we're even seeing it flat. And that's only makes sense in that it's peak driving season right now, and some of the refineries have come back online, so gas prices have dropped quite a bit in the States, so that's good. And yes, 1 million barrels a day per year is kind of a very steady increase as to what the world's seen over the last 2 or 3 decades. And so despite all the nervous Nellies out there and saying that we've peaked in the use of oil, we seem to be moving ahead very steadily, so that's bullish for the price of oil.
So what's the outlook long-term for oil? I mean, the world economy is not going to improve anytime soon, and the Middle East situation, that's a big question mark. What happens to oil prices going forward?
I think, particularly in North America, Phil, we're going to see lower oil prices overall. Like, oil is still going to have its ups and downs, but I think we're generally going to see slightly lower prices, maybe even $10, $15 a barrel lower than what we've seen recently, just because of the huge supply glut that we've got going on in the U.S. All this new light shale oil is now competing with Canadian oil sands production for pipeline capacity, refinery capacity. So simple supply-demand economics. More supply, lower price. Are we going to see a collapse in prices like we did in natural gas? I don't think so. But I think that, generally speaking, North American consumers should be able to enjoy lower oil prices and lower pump prices over the next year or two.
We're talking to Keith Schaefer here on This Week in Money, and we've got some oil news from different companies. Schlumberger and Baker Hughes just posting some profit numbers higher than expected. Halliburton coming out on Monday. They're going to report that their margins are being clobbered by something called a guar shortage, and you and I don't know much about this. It's a key ingredient, apparently, Keith, in fracking fluid, and about 80% of it comes from India.
It really shows what a global industry we have here. The fracking revolution has had it's so big, and it's been able to, not been able to, it just, as a fact of life, has shown that it affects a lot of people, including farmers in rural India who grow this guar and the demand for their product has just gone through the roof. So, those people are experiencing the benefits of fracking in the United States, where, basically helping them get lifted out of poverty a little bit by huge price increases for their guar.
Interesting to watch the rig counts out there. Here's news from Baker Hughes. The number of U.S. oil and gas rigs falling this week to about 1,900 and change.
Yeah, well, you're still seeing a collapse in natural gas rigs, which is so stunning. It just goes to show what's happening in the industry and how efficient it is, and that with an unbelievably lower rig count, you're still seeing record high production. We'll probably even produce more gas in the United States this month than we did in January. Unbelievable. So very efficient. You don't need near as many rigs to produce the same amount of gas. I do suggest that we will see lower gas production next year, though, which should be bullish for prices. But even on the oil side, Phil, which, the oil rig count has just been flying in the last year in the United States. And so now you're starting to see that kind of peak out a little bit. So it'll be really interesting to see how that impacts production early next year.
We're talking to Keith Schaefer here on This Week in Money. We're talking about oil and gas, specifically oil at the moment. From your Twitter feed, Keith, where you tell us you're watching for the strength in stocks of leading Canadian juniors. What's happening here?
Well, after the June low, we really saw a big bounce in oil stocks, and that was kind of led by oil prices, because the Canadian junior oil stocks were getting a really poor price for their product back in the late spring, early summer. And that was because some refineries were down. But now these refineries have come back on stream, and so the price of Canadian oil has jumped almost $20 in the last 2.5, 3 weeks. So you're starting to see the stocks in some of the leading juniors like Legacy, Oil and Gas, Whitecap Resources, Surge Energy, D3 Explorations. Now they've really started to bounce back, and to the point where they're almost hitting their first resistance level. So now today is our first kind of pullback day on this big run. So I'm just kind of watching these stocks now to see most of them have not yet broken out of their downtrend, but they're very close. And they're getting a little more volume. They're getting some insider buying. The chart's looking better. It looks like we could see a breakout here. So I'm just watching this real closely to see if we will break out.
Keith Schaefer from oilandgasinvestments.com here with us on This Week in Money. Let's talk natural gas. Prices hitting the highest level since January. Obviously, everybody cranking up the AC to stay cool. Natural gas hitting a new record, just over $3.
It's amazing to see the weather patterns in the United States right now. You are seeing probably the biggest drought in the United States since the 1930s Dust Bowl. So you're seeing record heat. The agricultural crops are just being decimated, and you're seeing ag prices just soar. And so that just gives you a sign of how hot it is, and it's been so hot for so long, way more than anyone ever anticipated, particularly after last year when we had quite a hot summer. So the air conditioning and the electricity burn has just been remarkable. And so, as we talked about earlier, the actual supply of natural gas is still at record levels. The industry has had no discipline. It's continued to produce, but the demand side has picked up so strongly because of all this heat. And so I'm kind of thinking myself, Phil, that we're probably peaking out here in both demand and prices over the next week or two. And then as we get into the shoulder season, I think we could see lower prices. But you can't argue with the weather, man. If this drought keeps up, all bets are off, and gas could really start to move even higher.
Lower price is probably a boon to the guys who generate power. The $3 price is a big psychological barrier. That's apparently where they switch from gas to coal.
That's what a lot of experts are saying. I think the jury's out on that. From everything that I'm reading, I'm going to suggest that it's probably a little bit higher than that. I don't think we're going to see quite the resistance from industry that a lot of pundits are thinking about at $3. I think that's probably going to be a little bit higher, $3.50. So it wouldn't surprise me to see us go through here. But these natural gas stocks, Phil, they've already had a pretty big run in anticipation of cracking the $3 level. So it'll be interesting to see if and when we do crack the $3 level, if these stocks will either gap up again, or if it will be a case of buy on mystery, sell on history, and sell on the news.
One of the big natural gas ETFs, the UNG, had a nice pop this week, Keith.
Yes, it's just amazing how that ETF just pours through the volume. And the chart on that's actually starting to look pretty good.
Is it sustainable, you think?
Well, like I said, that really comes back to the weather. So, but technically, that chart's looking quite good. It's passed above its short and medium-term moving averages, just about to hit its long-term 200-day moving average. So, if it can break through that, technically, I think you'll see a big spur of volume in a lot of gas stocks.
From Keith Schaefer's Twitter feed, drillers switching to natural gas. Apache converting its first rig to run on LNG. And Canna has 15 rigs driven by gas. They plan to convert more. And it's not cheap, but you can see obviously why these guys are doing this, right?
Oh, absolutely. You know, there's about a 2-year payback on natural gas conversion right now. And obviously these trucks have a much longer field life than that. So if you can hedge your purchases of natural gas out quite a ways right now, then you can be laughing all the way to the bank over the long term. So, we're just starting to see more and more of these fleets convert to natural gas. It's still the thin edge of the wedge,
sure,
but it's a good sign.
Keith Schaefer, editor and publisher of the Oil and Gas Investments Bulletin. He is online at oilandgas-investments.com. And you got a summit coming up in September, the Subscriber Summit. Tell me about that, Keith. How does that work?
Well, for the paid subscribers to my service, we offer 2 days a year, one in Toronto in the spring and one in Vancouver in September, where they can come into town, they get to meet the management teams of the companies that I cover, they get to spend a full day with me, we do breakout sessions, we listen to the presentations on the companies, and it's a very select group, it's a very small group, and this will be the 4th one we've done, and it's just a great way to really get to know the teams that you're investing in.
Keith, Go ahead, Keith.
So we get senior management from these companies that come out and tell their story in a very concise way, and then we have breakout sessions so you can ask them one-on-one questions and sit down and have a coffee with them, sit down and have lunch with them, and really get to know them and their business. And it's a great way to network and really help understand the business.
You can find Keith Schaefer on Facebook. Just search for Oil and Gas Invest. And don't forget Keith's Twitter feed at Oil and Gas Invest. And don't forget the website, oilandgas-investments.com. Hey, Keith, always a pleasure. Thanks for being back here with us today.
God bless you, Phil.
This Week in Money is archived online at talkdigitalnetwork.com.
David Skarica is author of The Great Super Cycle, Profit from the Coming Inflation Tidal Wave and Dollar Devaluation. And you can find Dave on the internet at addictedtoprofits.net. Hey, Dave, it's good to have you back on This Week in Money.
Thanks for having me. It's good to be here again.
Markets just closed, and a pretty good week for the Dow and the TSX. They're up 100 points on the week. And the S&P, a nice week this week, hitting a 2.5-month high. So what's been going on this week?
Well, we saw this kind of rally in the S&P. I'll start with those markets, and that's what I had been looking for. We got very oversold a few weeks ago, and then we've bounced nicely. But I'm actually looking at the markets potentially, and I'm just writing a report on this right now, topping out over the next few months. What I'm really looking for to happen in the markets is we usually rally during earnings, and earnings usually come in a little better than expected, even though some of the numbers have been notched down to the slowdown in the global economy. What happens with earnings is that, especially in the United States, a lot of these multinational large companies are able to borrow at such low levels right now. They really have high profit margins because they have essentially no interest expense on the money that they can borrow. So the earnings usually are coming in because of this low interest rate environment better than expected. So I was looking for a rally into that. But one of the key indicators I'm watching right now are the yields on Italian and especially on Spanish debt. And to me, they're almost like what the TED spread was. The TED spread is the difference between LIBOR and, interest rates in the United States. Mm-hmm. They're almost what the TED spread was a few years ago during the financial crisis in the United States, because they're a signal of stress in the European system. And I don't think we can have a substantial rally, meaning a rally that lasts 6 months, a year, 2 years, until those rates on those European economies come down. And, of course, today, as we're speaking, the rate in Spain has gone up to 7.27%,
wow,
which is a multi-year high. So that kind of tells me I think this is a bit of a sucker rally. And while the U.S. markets can continue to maybe outperform, because you're going to have, in the short to intermediate terms, money continue to flow into the U.S., I think that at some point the U.S. market is going to kind of roll over here with everything else. And I'm actually thinking, and as you know, you've talked to me for a while, and I'm not a doom and gloomer, but I'm looking at the potential of some kind of banking/debt crisis happening as soon as this fall.
Mm-hmm.
But I'm looking at it as being a fantastic buying opportunity rather than the end of the world. I think maybe a potential Greek default mixed in with, maybe Spanish rates getting into that really dangerous 8 to 9% range is kind of what may bring us lower into the fall and then bring this buying opportunity. And just as a final note here, if you look at the last 2 years, being 2010, 2011, actually August was a very weak month in the case of each year. So I wouldn't be surprised if this rally is actually kind of long in the tooth and we pull back for, say, August, September.
We're talking to David Skarica here on This Week in Money, and I guess one of the big drivers behind North American stock markets has got to be Europe, even though Eurozone finance ministers got that Spanish bank bailout going. The euro setting a 2-year low against the dollar. That's got to affect what's going on here for quite the next while.
Yeah, and again, I think right now in Europe, again, it's similar to 2008 where, okay, the market fell a lot from the summer 2008 into the fall. But by the summer in 2008, the sentiment was getting quite negative, but the question was just approaching the capitulation. And I think, and I hate to use a direct 2008 comparison because I don't think the percentage declines are going to be as large this time around. And we're seeing actually many commodities show sign of strength recently. So it's not like a deflationary thing like happened in 2008 or a deleveraging that happened then. It's more just this problems in European debt. But I think that we're kind of, again, approaching, like I said, this kind of inflection point and downward move in the market, and you kind of have to get ready for that. But here, again, this is where kind of it goes each way, where the weakness is coming out of Europe. That's ironically also where you want to buy.
Mm-hmm.
If you look at what these European markets are doing, they're going to be at those kind of like ultra low valuations that say the U.S. was at in the early 80s, where you're going to have, like, Italy trades at 7 times earnings, the Greek market trades at 3 or 4 times earnings. You're going to get these extremely low valuations at that kind of bottom, and I think a very, very, very strong rally off the bottom.
Lots of great companies in Europe still available, right?
Oh, yeah, and actually, not only that, if you can look at it, and this is, a lot of people will laugh at this, and you don't want to buy companies, obviously, they're going to go under, but a lot of instances, you want to buy the not-so-great companies, maybe the companies that have a lot of debt on their balance sheets and might look like they're going to have problems restructuring. That's similar to, say, buying like a company like Ford back in 2009. Is that because those companies have dropped in many cases 80, 90, 95%, and they're going to have very, very good leverage to the upside. But, yeah, if you're more conservative, you could just go in and buy some of the top-tier companies in Europe. You can go buy some of the ETFs, which are getting to the point where they're a great value investments. And two of the smartest guys I know right now, I don't know them personally, obviously, Jim Rickards and Mark Faber, they're both actually turning quite bullish on Europe. And in case, I don't know what Rickards is doing with his money, but in case of Faber, he's actually said recently that he's picking away at European companies because they're becoming so cheap. So I don't think we're quite there yet. And with the Italian markets, the day we're speaking here, and Spanish markets, the Italian market's down 5%, the Spanish market's down 7%. I still think we have maybe another leg lower, but again, you're buying a lot of these companies for 10, 20, 30 cents on the dollar,
yeah,
which is, very, very good valuation. And then, like, for example, on the other side of the kind of pond, I guess, when you look at the emerging world, like India, China, Brazil, the BRIC countries, there's a BRIC ETF in the United States, and that's trading at 8 times earnings. So even with those countries slowing down with their growth, long term, they're probably, as a foursome, going to grow between, on average, 5 to 7% a year. And you're buying economies growing at 5-7% a year, probably for the next 15 to 20 years, at single-digit PDEs. Again, cheaper than the S&P 500. So that, to me, these are where the opportunities are kind of arising, along with the gold equities, which still remain very, very cheap towards the price of gold, and some commodity equities as well.
We're talking to Dave Skarica on This Week in Money. The other market driver this week, the Bernanke factor. Markets hoping, obviously, for a little shot of QE. It did not happen this week. What do you think the effect is here?
What you mean in terms of QE on the banking sector?
On the market itself.
On the market itself. Okay. The QE. See, this is, I think, going to be one of the drivers of an equity rally or commodity rally. I just think right now we're in, I guess, a limbo or kind of a dead spot in terms of QE. And in terms of what I think is going to happen is the U.S. probably still won't announce it for another couple months. Europe is really reluctant to print the amount of money that the U.S. has printed. But I think if we see some sort of Greek default and mixed in with higher Italian and Spanish rates, they will be forced to do some kind of quantitative easing to buy that Italian and Spanish debt. And then India and China have started to loosen, but just started. They're in the early stages, and I think they'll get more aggressive with that later in the year. So I think we're kind of, again, like we're in the doldrums of summer. We're kind of in this dead spot, but it's like being in the eye of the hurricane that once the eye passes over, we're going to really start that money printing. And what's going to be really interesting to see here going forward is that, okay, in 2008, 2009, all the central banks everywhere printed money because of the financial crisis and liquidity problems. But in 2010, 2011, when the Fed, did QE2 and the Operation Twist, Europe actually raised interest rates. China and India raised interest rates to slow down their economies and slow down inflation. So really the U.S. was the only aggressive central bank at that time. And now we're probably going to have all three major areas of the world just being Asia, in terms of China and India, Europe and the United States, all loosening at the same time, sometimes later in the year. Now, I think this is actually going to breed more of a stagflationary environment. And because precious metals equities and oil and gas equities have gotten so cheap, they actually will probably lead the way along with the emerging markets in Europe. And this is the irony of it now. A lot of what's going on right now, people are moving into the U.S. as a perceived safe haven, but because of that, it's kind of propped the U.S. markets up. So on coming out of that to the other side, it's probably going to be the market that kind of lags everything else. So I would look at buying, like I said, in the emerging world, in Europe, in the precious metals and energy markets.
We are talking to David Skarica from addictedtoprofits.net here on This Week in Money. And gold kind of moving sideways this week, Dave. Still above the moving averages. Obviously, the main contributor got to be a drop in the dollar.
Yeah, I think we're to the point where, see, and this happened in each of the last couple of years when the euro, especially last year when the euro weakened, we're to the point where the dollar strength doesn't start hurting gold, it starts helping it. It's more euro weakness. So people, like today was a classic example. Gold was down in the futures market $5 to $10, early on, and actually it then reversed and ended up $5 or $10. Because what happens? People are worried over the euro. They're worried over banking crisis in Europe. So not only did they move the money into the U.S. dollar, they moved the money into precious metals as protection as well. So I think in these times you can get into a point where you can see the dollar rally with gold, as long as that dollar rally has to do with worries over what's going on in Europe. And seasonally, which is very, very important in gold, we didn't get this last year. Last year we got a spike in gold prices in July, August. But seasonally, we're now entering kind of the soft spot or bottoming area for gold. So I definitely think in the next few weeks you're going to want to be accumulating your gold. The HUI index, for example, on the gold front, the AMAX Gold Index on the gold stock front, it is basing between 375 and 425. So I think that if this base holds, we've also seen a nice kind of bottoming base in the gold stocks as well. So I definitely look at kind of purchasing your precious metals here in the upcoming weeks. And just so you know, the other stuff that I said earlier with Europe and emerging markets, I still think it's a little too early. I'm really looking at that happening more in the fall, the really exceptional buying opportunity. But with precious metals, I would say the time is basically now, and you can go ahead and do that.
Dave, you have a couple of great charts on your website comparing the price of gold stocks to the price of gold itself. What does that tell us?
I mean, the price of gold. Right now, the price of gold itself compared to the price of gold stocks. Yeah. The ratio I look at is the HUI to gold ratio, or gold to HUI ratio. So what you're essentially doing is you're taking that HUI index, almost acting like it's a share, even though you can't physically buy the HUI index. You can buy the GDX or whatever, but acting like the HUI index is a share and taking the price of gold, dividing that into it, and seeing how many ounces, how many shares of the HUI index it takes to buy 1 ounce of gold. And usually, historically, during this bull market of 2000 to 2012, it's taken roughly 2 shares of the HUI to buy 1 ounce of gold, which means that gold trades roughly double to the HUI. So if gold is, say, 1,000, the HUI should be trading at 500 or 400. And right now, the HUI is trading at roughly 400, but gold, of course, is nearly 1,600. So it takes 4 shares of the HUI to buy 1 ounce of gold. And that goes back to where it was essentially in the financial crisis, which means the gold shares are extremely, extremely cheap compared to the price of gold. And of course, if you look at what happened after the financial crisis, after those extreme evaluations happened, from late 2008 to late 2009, the HUI index more than doubled in price. So I think we're getting to an exceptional buying prospect for these gold shares. And right now, if you told me where I want to put my money, into the actual precious metals itself or to the gold shares itself, I would want to do the gold shares. And this all figures into what we talked about earlier. I think with the kind of risk-off trade that's on now, with all the central banks not committing to quantitative easing or money printing all over the world, that's holding back kind of the risk on people getting a little more aggressive buying gold and precious metal shares. And I would think that that may turn around, and we're going to see the gold and precious metal shares really rally once again all this money printing is announced and really occurs later in the year.
We are talking to David Skarica from addictedtoprofits.net here on This Week in Money. Dave, give us an overview of the special offer you got going. How come we save 25%? That sounds attractive.
Well, right now the special offer I have going is I used to charge $3.49 for my newsletter. I now charge $4.49. But I decided to give one more special offer. I guess because golds are on sale, why not put my newsletter on sale? One more special offer, and it's only going to last like a few days here, where you can buy the newsletter for $349 for 1 year. And if you go to my website, addictedtoprofits.net, you'll see I have a analyst report on a certain gold company, which I own and which I like right now. And it's kind of a sampling of the type of reports that I do. So you just go there, see if you like the report. And like I said, I don't think this offer will probably last more than 3 or 4 days. So you kind of have to act soon to get it. But if you're interested, just read the report, see if you like what you see. I give a brief overview of what I offer in the newsletter, and hopefully you'll sign up and become a subscriber.
David Skarica is author of The Great Super Cycle, Profit from the Coming Inflation Tidal Wave and Dollar Devaluation. And you can always find Dave online at addictedtoprofits.net. Hey, Dave, thanks for talking to us.
Thanks for having me.
Thanks to our guests, David Smith, Keith Schaefer, and David Skarica. And thank you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.